Hey guys, Andrew here from Learn How to Trade Online, and in this video I really want to just talk a little bit about how important the price action really is. Alright, so I've got a clean blank chart there, nothing else on it but the candles. Now, a lot of people think they need loads of different indicators, RSIs, MACD, stochastic, or they need Elliott waves and Gann theory and loads of support and resistance lines and harmonics and whatever else you want to add onto the chart. Well, let's just go through and analyze some of that stuff first of all. Okay, well, making a note here straight away, Gann died broke. So using Gann theory, in my opinion, is absolutely pointless. The guy died broke, he obviously couldn't trade. From that, then Elliott, he left a very moderate inheritance. Alright, so all the Elliott wave theories, EW, Elliott wave, I think it just stands for eventually works out. Again, he didn't make a massive amount of money. So again, I'll take what he says with a pinch of salt. When you start looking at harmonics, and you look at really the father of harmonics, I'm going to say, is Scott Carney. So harmonics do work. There's no two ways around it, because it's focusing on market structure, and Scott Carney's the guy that basically created harmonics in its modern day form. There's been people that have done a bit more beforehand, like Gartley, and there's people that have also done a bit more since. But ultimately, if you think of the one person responsible for harmonics, Scott Carney's the guy, and he's made some decent money. He's also an incredibly smart guy as well, so fair play to him. He's been very successful in the markets. So harmonics is definitely one way to look at it, but it is price structure he's looking at rather than just Elliott waves. So he's giving specific levels where he expects price to turn, and all he's using is then Fibonacci ratios. Now, if we just left it at that, I would say that's fine. But if you go through Scott's books, you go through some of the things that Scott covers on harmonics, he mentions something called a PRZ, a price reversal zone. Now, that basically means he's then looking at price action. Okay, so price action for him is an important factor. It's not just about trading off the level itself. So when you look at harmonics, all they're doing is giving Scott a zone to trade from. He's then using price action to determine, is price going to blow through the level here, or is it going to reverse? All right, and that again comes back to price action being very important. Now, there's a lot of different ways to trade. You could look at a bunch of different indicators. You could look at lots of different styles, support and resistance and everything else. If I just throw on a random Euro USD chart, zoom out, I'm just going to place a bunch of random lines. Let's just make these a bit more visible. Literally placing random lines on a chart. Let's go here. Just squeeze it back a little bit more. Carry on placing random lines. So I'll put that one there just because there's a level. But let's throw a few more on. Okay, I can't even see anything up here, but I'm putting random lines on a chart. This line here, completely random. Now, if we go back and look through this chart properly now, let's just zoom it back a little bit, you'll be able to see that these random lines that I drew somehow have been bounced off of, treated as support and resistance. Now, how could I have possibly known that? I've not memorized price levels here. I just threw these lines up wherever. Underneath current price, above current price. Somehow, I've managed to pick turning points with really remarkable accuracy there. All right, now that is the kind of the reason why I think support and resistance is a bit of a fool's errand, because support and resistance in the short term can work really well because of false breakouts, because of market manipulation. But I just drew completely random lines. I was here. I couldn't see where I was even drawing these lines. I certainly wasn't looking for big round numbers. I was just placing random lines on a chart. Yet when you go across there, you see I've somehow managed to pick out turning points on the chart. That's just luck. Nothing else. All I've done is place random lines, and somehow I've managed to pick out every single turning point. Now, here's the thing. Have I really? Have I really been able to pick up on every single turning point? Well, if we look at this, this level didn't get respected. This level didn't get respected. Apparently it did here and here, but this one didn't get respected. It did here. Didn't get respected. Didn't get respected. Didn't get respected. Did. Didn't. Didn't. Didn't really here. Depends on what you're aiming for. Didn't get respected. There's a bit of bouncing around here where it works. This didn't work. This one didn't work. This one didn't work. Yet, technically these were levels back over here that they just don't work in real time. All right. I can see this line here. I could plot it. I could see this one. I could plot it. But ultimately, do I know it's going to turn perfectly these zones? No. Support and resistance is just a little bit of guesswork, to be quite frank. You're better off getting rid of all of your lines off your chart, having a completely blank chart, and only using the short-term support and resistance that's around you. Because the reason why support and resistance works, let's really get into this. You have price move, okay? The reason why support and resistance works is because people put their stop losses behind it. That is the only reason why it works. Because if someone's bought here, they've got a stop loss more than likely underneath that support level previously. So when we come back down here and they get taken out to the marketplace, their stop's been hit. Now with their stop being hit, it's just a false breakout. Okay? It's not because it was a support level. It's just because the stop loss got taken out. That's the reason why short-term support and resistance can work really well. And it's why longer-term support and resistance is a bit of guesswork. Okay, so if I draw on this level here, all right, you can see it bouncing multiple times through here before it breaks. That's absolutely fine. Similarly here, bouncing multiple times before it breaks. But look exactly what's happening here. All right, you don't know this is going to happen yet. This stuff here. So you've got this. Anyone that's short through there has a stop loss here. Why do you think we take that out before moving down? Anybody that's long through here has a stop loss down here. Why do you think we take that out before we move up? Anybody that's sold through here has a stop loss here. Why do you think that gets taken out before we move down? Anybody that's sold through the second part of the move has a stop loss here. Why do you think it gets taken out before the move? All right, so short-term support and resistance can work very, very well. All right, but it's the short-term stuff that works. You don't want to be plotting levels from 3 years ago and hoping that it's still going to be, reactive today, because no one's got their stop loss there, or no one of any importance has their stop loss there. And the whole reason why markets move is because of the flow of money from buyers to sellers. All right, and the point is that when people are getting stopped out, that's usually a shift in the market from buyers to sellers. Not just when you're getting stopped out, but when groups of people are being stopped out. And we all know that the vast majority of people have stop losses behind major highs and behind major lows. Now, they may be a little bit more than you use. People might have their stop loss a little bit less than you use. But the simple fact of the matter is that there are stop losses behind these lows. There's stop losses behind these highs. And this is just stop hunting taking place. They're just taking the stops out to create liquidity to reverse the position. Taking the stop out through here to reverse the position. All right. So short-term support and resistance, fantastic. Short-term levels work really well. Longer term is a little bit questionable, because if I can draw a bunch of random lines on a chart in completely empty space, yet somehow they bounce in the past, that can't work going forwards. All right, you can't plot levels in the past and hope that they're going to react in the future. You want the recent short-term highs and lows, because that's where people have got their stop losses, where people have got their targets, and ultimately where you see money changing hands.